It is illuminating to look under the hood at the line item components of the big inflation indexes: peanut butter, pet food, smartphones, car insurance. But it is also essential to examine the big moving pieces. So today, 3 big trends to keep an eye on to see if we are tracking back down to the Fed's target of 2% annual inflation, or if we are settling out somewhere a little higher, which could put policymakers in a bit of a pickle. First big trend: durable goods other than cars. So we're talking about appliances, furniture, tools, TVs, bicycles. This category in the PCE is about 11% of our average annual consumption. And unlike most of our spending, durable goods like this have tended to go down in price. In the decade before COVID, durable goods had an average annual inflation rate of -3%. That's thanks to better manufacturing technology and global trade. After COVID, strong demand plus supply chain problems drove inflation over 5% here before gliding back down where we're used to. But that's not great. Deflation in durable goods slowed in 2024, and we are now back in the inflation zone. And that's with the effects of tariffs still rolling out to store shelves. Why is this so important? For decades, deflation in durable goods has reliably offset the much faster rising prices of almost everything else. Without that effect, getting back to overall inflation of 2% will be harder. Much of that everything else falls under a heading called market-based services. Airfare, Taylor Swift tickets, many healthcare expenses, any service where the price is set by markets and not by the government. Rent is in there, although not mortgage payments. It's a huge component, almost half of our spending. Before COVID, market-based services averaged right on the Fed's 2% overall target. Since then, it rose and fell, and are we done? Let's hope not, because it's hard to imagine 2% overall inflation if market-based services can't get back near that level. And the final big category to watch: housing and utilities. This is about 18% of our spending in the PCE. Housing has long run hotter than overall inflation. After COVID, it spiked way up, and economists have been relieved lately to see much slower growth in these housing costs. But like that broader market-based services category, you can see it matters a lot where we go from here. One good sign, perhaps, over the past few months, it is the volatile utilities component of housing and utilities that is on the rise. Rent itself is continuing to fall. Keep your own eye on the data, and I'll see you next time we pull something out of the basket.